Now, patience. You can't buy it as easily as a stock, but it's a necessary requirement, at least if you want to make money in some shipping stocks. Well, so says my next guest. Natasha Boyden is a managing director and an analyst and expert at Cantor Fitzgerald. She follows the shipping industry pretty closely. Natasha, it's good to have you with us. Thanks very much for coming in.
Nice to be back. Thank you.
So what's the state of the shipping industry, right? The BDI, Baltic Dry Index, that's always this sort of benchmark, it seems. What do we look at when we look at that chart? Good, bad?
For BDI, I mean, a lot of people are using it as a barometer of how healthy world economic trade is, which it's fair enough. It's been fairly well correlated. It's fallen off a little bit over the last month or so, but it basically takes into account the Cape-size market, which is iron ore, coal and grain, the Panamax market, which is more coal. So it's a number of commodities that I think are a leading indicator of as to where we're going. And then, of course, there's also the BTI, which is the Baltic Tanker Index, which has been very bad.
Just put it in a nice Wall Street term, right? It's been pretty dreadful.
It's been tanking, no pun intended.
All right, it's been tanking. So what does that lead you to believe about the future right now? I mean, does this signal any kind of health or rebound, or do we just have to sort of bubble along and see what happens?
Well, I would say with the tanker market, you know, one thing that's very interesting is that the IEA, which is the International Energy Agency, expects oil demand to fall to about 2.2%, decline of 2.2% year over year, which would be the lowest level in 5 years. So that doesn't look good. You had OPEC making cuts of about 4 million barrels a day back in November. And then you also have an extremely high level of inventory. In fact, it's almost the biggest since it's been to the build-up of the Persian Gulf War.
And yet oil is like $70 a barrel.
Oil is $70, but the thing with tankers and oil is it's not a direct correlation. It's more about supply. Actually, how much is being pumped out of the ground in order to, it's the crude carriers to take them to refineries, and then the refineries
or to just sit with it in the open season, wait for a space either at the refiner, because the refiner doesn't want to refine something they can't make money on.
That's a very good point. In fact, there are about 30 to 35 VLCCs right now being used as floating storage.
Very large crude carriers for those in the industry, right? Very large crude carriers. And you say there are 30 to 35 of them just sitting out there, full of oil.
Exactly, full of oil being waited, just waiting. You know, that has, one would think that would help the tanker industry in terms of taking supply out of the market, but it hasn't. I mean, it's just been, demand has been so dreadful. You also have the problem of when we get backwardization in the oil price, if that happens, those Vs will come back into the market because there's no use to keeping this floating storage. So that will just add more supply. The order book is ridiculous. It's about the order books.
When you say ridiculous, that just means there's a big
very large.
There's a big order book out there. I mean, but why would you fill the order book if you don't really entice making money on it?
Sure. I mean, in terms of cancelling or delaying orders for 2009, it's pretty much too late. You really can't cancel them. And you know, for 2010, we're seeing a little bit of slippage. But unfortunately, China has come out and said that they are going to support their shipyards under any circumstances, and they're going to build the vessels that are in there. Taiwan has also been looking at that as possibly a way to support their economy.
Ship shows up, you better take delivery. Exactly. The guy's going to stand there and ask you for the rest of the money.
Exactly.
You use that as sort of a segue to talk about, I want to start with one company, Tsakos, because this is the crude and product carrier, and I believe, according to your most recent note, they're taking 2 new builds, right?
They are taking 2 new builds, and in fact, 3 new builds. 3 Aframaxes. What is interesting is they actually bought them well before the bubble, so they got them at a good price. They can certainly pay for those out of cash on the balance sheet and free cash flow being delivered. We also like them because their contracts are built in a way that they have a lot of profit sharing, which is obviously going to benefit them in a down market. They have a very young fleet. The management team is top-notch. And they have a substantial amount of cash on the balance sheet.
And they beat the last time they came out with their quarterly report, right? I mean, was it 51 cents a share?
So we had 44. So it was, you know, it was a nice surprise. They also have around about $230 million in cash on the balance sheet. So they're sitting pretty, and we think in terms of value, they're a nice stock to be in.
They are a survivor.
Absolutely.
Okay, all right. Tsakos Energy Navigation. All right, we're going to come back. We're going to have more with Natasha Boyden. Some shippers are actually making money in spite of these rough seas. We're going to talk about Cape-size vessels. We're going to talk about the iron ore market, as well as what's going on with demand in China. This is Taking Stock on Bloomberg. A programming note, Bloomberg's Taking Stock begins each weekday at 3 p.m. Eastern on Bloomberg, 1130 AM, XM Channel 129, Sirius Channel 130, and on Bloomberg.com. And yes, Taking Stock is now a podcast at Bloomberg.com and on iTunes. Well, no, that wasn't two views of the economy. This is Taking Stock on Bloomberg. I'm Pim Fox. We're talking about the state of the shipping industry. My guest is an expert in the field, managing director and analyst at Cantor Fitzgerald, Natasha Boyden. Natasha, good to continue the conversation. I know we were talking about the tanker business. You said that that's tanked, but Tsakos, that's the one to hold on to, and that's going to be a survivor. All right, talk now about what's going on in the dry bulk sector. I know you want to talk about Diana and Genco. Are they also survivors in the field?
Absolutely. Diana is probably one of the best positioned companies in the fact that they have almost no debt on the balance sheet, which is pretty much unheard of. They also have about $200 million in cash on the balance sheet. They have
cash and no debt.
And no
that
debt.
Seems to be the flavor of the month for survival, right?
Absolutely. We saw, when the dry bulk market actually collapsed at the end of last year, the majority of these companies had to really renegotiate their loan-to-asset value covenants, put them in a very difficult situation. Clearly when you have a company or companies like this with very high capital-intensive requirements, there's going to be a lot of debt involved. But as you know, trade credit just fell off the map. So that's been pretty difficult for a lot of these companies in order to stay in compliance with their loan-to-asset value covenants. Diana doesn't have that issue.
Talk about the actual ships, just so that people understand. For example, Diana, you talk about Cape-size. Now, why are they called Cape-size?
Because they go around the Cape of Good Hope, down via South Africa and back up. They're too big to go through the Suez Canal.
Okay, so this means also that the day rates, are going to be multiplied because the amount of sailing days is going to be a lot longer.
Sometimes, sometimes not. As we saw at the end of last year, Cape rates went down to $5,000, $6,000 a day, which is pretty much virtually, almost owing money because of bunker costs.
Cost more to actually operate the ship than you're pulling in on a day rate.
Exactly. So a lot of these ships were in a fair amount of trouble then, but the market has rebounded nicely, which I think has been a surprise to everybody because we really didn't see that. But I think a lot of it is due to the China stimulus package, $585 billion over 09 and 10. 50% of that is for infrastructure investment. We've also seen, which has been a real surprise, record imports of iron ore into China.
What do you make of that? Is this stockpiling, or are they actually using the stuff?
Well, steel production has certainly been up about 2% year over year. There's been about 317 million tons today. The forecast, though, is 585, so that automatically implies that the second half is going to be lower than the first half. The iron ore inventories have been a very tough nut to crack. You've had the negotiations between the miners and the steel mills, which has been very, very controversial. This year you've had the Chinese government taking into custody Stern Hu from Rio for spying, bribery, all of that. It's...
They're playing hardball.
They're playing hardball. A lot of the inventory could have been them being able to have a good base of saying, okay, we don't need that much iron ore from you, so we want a lower price. Some of the smaller mills in China have actually disobeyed the central command and have been importing more than they were supposed to. There's a move from domestic iron ore to imported as well because it was cheaper at that point. But the prices are rising. We almost certainly could see a move back to domestic iron ore usage by China, which clearly would lower demand for international iron ore.
But right now, you think that are the ships still moving with iron ore?
The ships are definitely still. They're still moving. The inventory is about 75 million tons at the ports. They're still moving, but we do think that the Cape rate is certainly going to come down a little bit, soften out from what it was at the first half of the year.
So this is not just a one-way ticket straight up in terms of prices.
It never is. You've also got a very large order book. Although a lot of it was delayed, it's still going to come in somewhere, somehow. We have seen scrapping, but that's dropped off in the last couple of months. So it's never an easy...
Sounds like a much more complicated picture in the world of shipping than it was a year or two ago.
Absolutely. And then, of course, you have the banks who don't want to, issue debt or do that because you've got a lot of these companies who still have waivers. It's a pretty interesting market right now.
So you've got to basically, focus on companies that have very clean balance sheets, have cash available, and aren't, scheduled to take delivery of huge numbers of ships?
Well, Genco does have 2 Capes coming in, but if you think the Cape market is going to stay pretty level at a pretty good price right now, that would be good for them. They recently signed 1 new build coming in at $36,000 a day, which is a great rate. So Genco is a nice way to sort of almost play the upside, but definitely have the downside protected.
Because you've got that idea of the contracts. How far out do they go?
They go out about a couple of years.
So at least there's some annuity-style income.
Yes,
They've got something coming in over a period of time.
66% of their days fixed for this year. So.
All right, and so buys right now, on Diana Shipping as well as on Genco?
Absolutely. There's some that we certainly have sells on.
Go ahead, share one of them. Go ahead, or should I not put you on the spot? Go ahead.
No,
Go ahead, share one of them with us.
XL Maritime, EXM. We think they're in. They have a lot of debt. They have older vessels. The rates that they're getting for those vessels are not good. So yes, they have gotten waivers, but those waivers aren't going to last forever. At the end of this year, we may see a whole host of companies having to renegotiate.
How about takeovers? How about consolidation in the industry? I mean, you think we're going to see some of that?
I don't really think anybody really has enough money for that right now, and I think the assets haven't come down to the distress level that they would like in order to make that acquisition. We may see onesies and twosies in terms of 1 ship or 2 ship. But I don't think we're going to see massive consolidation in the public companies at this point.
All right, last question, though, on Genco. You lowered your price target a little bit. Was that just really sort of dealing with reality and kind of taking a look
Yeah, we also went out to 2010 to start valuing on 2010. And, we usually lower the multiple a little bit when we go out that much further because, the time value and all of that of money.
And also it becomes a little bit more uncertain.
That's absolutely right.
All right. I want to thank you very much, Natasha Boyden, adding a little certainty to our understanding of what's going on in the shipping industry.
Anytime.
Got to buy on Tsakos as well as Diana Shipping and Genco. Appreciate your information on tankers as well as the dry bulk sector.